the webinar will be recorded, and we'll be circulating that following the webinar, as well as making it available to our cohort and larger community. That being said, I'd like to introduce the hosts of our webinar from Shoobx, one of our 2019 Clean Tech Open Northeast in kind sponsors. Joining us from Shoobx and speaking with you this afternoon, we have Bryce Del Grande and Kathy Nolan. As I mentioned previously, for those who were not online earlier to ask questions, we do ask that you hold and keep yourself on mute throughout the duration of the webinar. At the end, Kathy or Bryce will welcome you to unmute yourself if you have any questions. If you'd like to, during the webinar, ask a question in the chat box, you can do so by typing into the chat box that will be on the right-hand side of your Zoom controls. Feel free to type a question in at any point, and Kathy and Bryce will look to address it either during the presentation or shortly after. Again, just asking that everyone stays muted throughout the course of the webinar until Kathy or Bryce lets you know that we have reached the questions portion of the webinar. So with no further ado, I'll turn it over to Kathy and Bryce Shoobx, who will be leading this afternoon's webinar.
Cool. Thank you so much, Trisha. This is Bryce Del Grande from Shoobx, part of the customer success team here with my Kathy Nolan.
Hey, how's it going?
Shoobx, for those of you who haven't met us or haven't heard of the Shoobx, we are essentially an operating system for startups. So we help folks like you all who are seeking to scale, raise venture capital, and hopefully eventually see some exits with their management of legal automation through the lenses of equity financing, managing equity and ownership, corporate governance, and human resources. I myself come from a couple of startups in CS and sales background, and I'll let Kathy introduce herself briefly.
Yeah, absolutely. So I've been at Shoobx for about 5 years now, helping startups and sort of educating them in topics about equity, fundraising, and hiring. And I come from a legal background.
Cool. So today we're going to be talking about understanding equity, both what that means in terms of founder ownership, your development of your cap table and your ownership over time, and how that will relate to future fundraising for your company. As Trisha mentioned before, if you have any questions as we're going through the presentation, feel free to drop them in the chat box, and we'll also have a pause at the end of the presentation to address any questions in more of a free-form style then. Can everybody see and hear us okay? If you don't mind chatting and answer just to make sure that we're all good from an audio-visual perspective, that would be super helpful. Perfect, thank you. Wonderful. So to kind of dive in to our presentation, I'm gonna let Kathy kick some things off here on cap tables.
Yeah, so the talk is about understanding equity, but it's mostly structured around, as your cap table builds and moves through the different stages. And the reason why we're so focused on the cap table is it's essentially the summary of who owns stock in your company, how much stock. Most of you probably have one, and it's just so essential when you're talking about equity in a startup. So for those of you who don't have a cap table yet, you will soon, and it includes people that own stock and also people that don't own stock yet but will have a right to buy stock in the future. For example, people who have options to buy stock, or people who have warrants or bridge notes or anything else that gives someone a right to preferred stock in the future. In terms of who is going to be looking at your cap table, who isn't going to be looking at your cap table, essentially, besides internal company use, investors will also look at your cap table when they're considering investing in your company, and they'll use it to see who owns what of your company. And this means that they'll notice if, you and your co-founder broke up and your angry co-founder left with 50% ownership of the company. Or they'll also notice if you haven't been thoughtful or strategic in how you distribute options. And we'll talk a little bit about that later. They'll also use your cap table, investors will, to see how they would fit in after they invested in you. So if they bought, X shares, how much of your company would they own? 10%, 80%? The cap table will make that clear for them. The cap table will grow with your company. So you'll start with just a few lines, maybe just founder shares, common stock. Then you'll establish a stock incentive plan to give common stock or options to your employees, advisors, board members, etc. And then as you bring on investors, your cap table will become more complex. Your stock classes will start to increase, and you're going to start to issue preferred stock, and it's going to get a lot more complicated. So does everyone know, I guess you could chat in the chat, if you will. Does everyone know the difference between common stock and preferred stock? At the stage you're at, is that a distinction that you're comfortable with? So common stock has no special preference during liquidation and no special benefits. Preferred stock is sort of what it sounds like. It's preferred. So the investors typically pay a lot more for those shares, and they have preferred liquidation in event of an exit, which investors pay handsomely for. So at the end of the day, the cap table governs. So it tells the true story of who owns the company, and whoever owns the company controls the direction of the company. So a lot of times founders are extremely excited to be a founder and control the vision and direction, but you will not control the direction of your company because you care the most and you have the title of founder and your blood, sweat, and tears went into the company. You will control the company if you control the cap table and you actually have the shares so that your voice matters. And it constantly is changing. So when you look at the cap table 6 months ago and you owned 80%, don't be surprised if after a few hires, a few investments today, you own 30% instead. And there's always strategic reasons for that to happen, for your ownership percentage to go down. You might want to take on new investors, incentivize new employees, but you should take these on only if you understand and accept the impact it's going to have on your ownership and company control. So that's what we're going to talk about today.
So as Kathy was talking about, when you first start your company, you're going to incorporate, and that's when you start building the story of your corporation. As you go through these additional events, the financings, the hiring of employees, you're adding on to that story, but each stage is going to be important as you head into the next. And the cap table in some ways is a vehicle for telling that story, right? It's telling the story of who owns what, when they came to own those pieces, but it all starts with incorporation. So specifically here at Shoobx, we work with Delaware C corporations. Part of that is because generally when we're talking about companies or startups that receive venture capital backing, they're a Delaware C Corp. By far the most common designation of corporations here in the US, and specifically through the lens of venture capital. If folks want to chat in, is there anyone here who's listening in today who is not a Delaware C Corp? Or who has not incorporated at all? It's okay if you haven't.
Yeah, we're always just interested in the makeup of who's here, because it's always a mix.
Wonderful. So not incorporated yet. Thank you for your response. It's something that, as we talked about from a legal governance status, will be the beginning of your story. So when you're thinking about how you incorporate or what you incorporate as, you really want to think about some of the implications of that as you continue as a corporation. As I mentioned before, Delaware C Corps, US Delaware C Corps specifically, are typically the designation that we see both here at Shoobx, but also in terms of raising capital. Part of that is because of ownership structures and a bunch of other things. But some of you who were at the event, I believe, last week here in Boston at Mintz might have also heard from, I believe, Sarah of Folioag talking about Delaware C Corps versus LLCs. If you are planning on raising capital, if that is your goal, your trajectory, your path forward, we would highly recommend you thinking about what those goals are and making sure that you're talking to your attorney about aligning with them. Because the further you make it along your journey as you look to convert or clean up that history and that story, the more complicated and more difficult it can become. So really setting off in the right foot is something that you should definitely be thinking about at this point in stage.
Yep. Another thing to mention is whether you're not incorporated yet or you're a non, Delaware C Corp, if you talk to your lawyer and you find that you should be incorporated or another corporate form works better for your purposes, it is easy to switch. So the next slide is incorporation. Can you guys see the slides? I'm getting some comments, maybe you're not. Okay, perfect. So in terms of incorporation, as we mentioned, you guys might not be incorporated yet. You might be incorporated, not in the US or as an LLC. That's all well and good. If you decide to raise venture capital money from US VCs, odds are you'll end up as a Delaware C Corp. So this will still be relevant to you because if you're interested in venture capital money, this will probably be your corporate form. So it's just, a little bit in the future for you. So in terms of incorporating, it's probably the simplest thing you'll ever do as a startup. And if you've already incorporated, you'll spend the rest of your corporate life explaining to people what your corporate form is. And in the case of a due diligence, producing these documents to sort of prove that you've done it right and that everything is in order. So the key concepts for incorporating is you'll create a charter, and the charter will contain your authorized shares, which is different from your issued shares, and your par value. So let's tackle authorized shares first. Authorized shares are essentially all of the shares that you've announced to the state of Delaware, in this case, in our example, that you have in your company. So the easiest way to understand authorized shares is to compare it with what it's not, which is issued shares. So let's say you have authorized shares. Let's say you have 10 million authorized shares, which is a pretty common number we see a lot in our clients. You may grant some of these shares. You may grant none of these shares. You just have the ability to grant them. That doesn't mean that you will. So in this example, that's similar to a pattern we see a lot in real life. A company has 10 million authorized shares in their charter, and then eventually they might grant, let's say 3.5 million to the founders collectively. So the 3.5 is the actually issued shares, and they'll leave about 6.5 million open to put in a stock incentive plan when that time comes, or maybe to make sure that there's a common stock equivalent for the preferred stock if they end up getting preferred investors. So as a founder in this example, you cannot grant yourself more than 10 million shares because it just doesn't exist. You'd have to go back to the state of Delaware and say, I'm amending my charter. I'd actually like, 11 million shares. So that's the concept of authorized shares. That's how you start out in an incorporation with only authorized shares. You haven't issued any yet. The other concept in incorporation is par value. Par value is a very antiquated concept. It's essentially a number, and this number is important because you cannot grant shares lower than par value. So let's say your par value is 1/1000th of a penny. You cannot issue shares that are cheaper than that. This is not to be confused with price per share or fair market value. So par value is the antiquated concept that you declare on your charter. This is my par value, meaning you cannot go below this number for granting shares. The price paid is what someone is actually going to pay for these shares. So if you grant shares to a founder, it will say, I'm giving these shares to Bob, and the price paid per share is, and it may very well be par value. It might be far more expensive. It might be $1. And then the grant will also say the number of shares. And then a third related but again, different number is fair market value. So that's what the shares are actually worth. And for tax reasons, most people are trying to grant shares and have the price paid be equal to the fair market value, but not all the time. Sometimes all three numbers will be different. Sometimes all three numbers will be the same. It varies. But, if you remember nothing else from this slide, just remember that, when people say, oh yeah, those shares are, a cent. A cent what? A cent par value, a cent fair market value, price paid, just sort of, keep involved and keep interested in what these numbers actually mean. So at the end of incorporation, this is what your cap table looks like, which is to say you have no cap table. You haven't actually granted any shares, and the definition of a cap table is you've issued shares to people or entities. So you've authorized, in our example, 10 million. You've issued no shares, you have no cap table. But that's next, that's the next step.
So when we move on to the next step of the process of forming, creating, scaling your company, we're talking about post-incorporation. So this is granting founder shares, or what also might be referred to as splitting the pie. So we have a company, our company now exists, it is a legal entity, we have a pool of 10 million authorized shares, and Kathy and I are gonna say, we're gonna divide the company. Let's each own half of it. Great. We now own half of it, except you don't yet. Oftentimes we'll see people going through the incorporation process thinking that their verbal agreement, or even sometimes informal written agreement, is the equivalent of actually granting those shares. What needs to happen next as part of the incorporation process, or post-incorporation process, is you will actually draw up the paperwork to grant or issue the founder shares among the founders. So until you actually have the papers which state how many shares that each founder owns, no one actually owns anything of the company, and your cap table will continue to look blank like the previous slide. So in our example, we're talking about dividing 3,500,000 shares between the founders. We're actually going to go and grant that paperwork, create that paperwork, but oftentimes there's a lot of questions about, how do we go about that? What are the things that we think about? How do we split that pie? So over here we see on the right in this example that we split them evenly. So they kept a pool of options or shares available for employees in the future through the stock incentive pool. And then the founders both received an equal number of issued shares out of that pool of 3,500,000. This may not always be the way that you want to divide the company. How do you determine how much equity someone should own? Part of the way that we kind of like to think about it, and most of the way that we see companies think about it, is really from an emotional or a relationship-based standpoint, right? So you, as founders, want to walk away feeling comfortable with not just how much you own, but how much the other founders own. Do you feel like that accurately reflects your contributions to the company and your commitments? Do you feel like your skill sets and the things that you bring to the table are reflected? And oftentimes what we see with the thousands of companies that we work with is that may not be a completely even fit. That might not be 50% of that 3.5 million to Kathy and 3.5 to me. Maybe because Kathy is working on the venture full time and I'm working on it part-time because I have another job. Or maybe Kathy came to the company with a bunch of IP or other things that were valuable in our founding. These are all things that you want to think about as you're having these discussions to make sure that you're getting to a place that you all are comfortable with and moving forward in your company. The one thing to note there is the founder shares, or the original kind of issued founders grants, are not the end all be all. We do often see companies continue with follow-on grants to maybe redistribute the equity piece. So in the example that maybe one of us is not full-time at the company, I decide, 6 months in, that I want to take the leap to also be full-time. Maybe we want to create a follow-on grant to readjust the equity distribution before other folks come into the pot. One of the other things to think about in terms of your ownership is investor perceptions. So again, as the cap table is kind of the book or the reference guide that you are sharing with investors and other folks looking at your company to tell the story, what does the distribution say? Is it going to be something that makes sense to an outside eye? Will they have questions about how decisions are made? Maybe if the ownership is distributed evenly. If I own 50% and Kathy owns 50%, and a decision needs to be made, who ultimately makes those decisions? These are all things that you want to think about, and investors will think about as they're evaluating your company. And then a final note here, Kathy talked a little bit about price per share. She talked about par value. She talked about price paid. All of these items earlier. One of the things that you want to make sure of when you're going through issuing those shares is you're not using the founder shares as a vehicle to get money into the company, right? So when I take my 1.75 million shares, I don't necessarily want to take the money that I might bring into the company, if I'm going to do so, as a fair exchange for those shares, because it's going to alter essentially what I have paid for each one of those shares, right? There's different ways that we can, as founders or as investors, bring money into the company that we'll talk about a little bit later that are a more appropriate place for that. So here's a sample cap table of an early stage company that has went through the post-incorporation process within the Shoobx platform. We'll see all of our shares at this point are common, and they're allocated among the three founders, Richard, Ehrlich, and Dinesh. In this example, right, it's not an even distribution. Richard is holding the vast majority of the initial shares, and we'll see that the fully diluted stock is going to be the same as the common stock, but more on that later.
All right, so let's move on to the stock incentive plan. The stock incentive plan is, for me anyways, one of the most interesting stages of a startup's life cycle, because no one wants to set up a plan, right? It takes a lot of time and effort to learn what is a plan, how should I set it up, how do I responsibly do it so it fits my company's needs. It's just a lot of work. However, most companies can't get around a plan if they are growing and if they are taking in venture capital money, because the point of a plan is to set shares aside to get the board and shareholder approval that, let's say 500,000 shares will be set aside to reward employees, advisors, whoever. And it also is usually set up by whatever attorney is advising you fairly early in the startup's life cycle to avoid violating securities regulations. So it's usually inevitable, but it's sort of assuming that you're going to grow very large. So the point of a plan, as I mentioned before, is to set aside shares. In this farmer graphic here that our designer went crazy with, you can see the sort of analogy that the total authorized shares, so that's the number that we said was 10 million, is everything that is gated. And then the stock incentive plan is sort of this smaller little patch to the side. And then within the plan or outside the plan, you issue shares, which in this case are the vegetables. Another more serious way to sort of imagine this is you have your 10 million authorized shares, which again, 10 million is an example number. So no worries if that is not your exact authorized share number. The original founders' shares are the green in this diagram. And then the stock incentive plan is the orange. So you're setting aside shares before you actually grant them. deciding on what pool you'll use in the next 2-3 years to reward the people that are working for you, and then you gradually would grant all of the orange until you completely ran out of shares in your plan. So one of the most common questions that we get is, what size should the plan be? Which of course is ultimately a question for your lawyer. In the graphic we threw up a few slides ago, the example had 10 million authorized shares with 500,000 for your plan. We see that sometimes, but no one size fits all. So at the end of the day, it's going to be a conversation with your lawyer, giving you legal advice, saying, according to your situation, this is your number. But it's helpful to know, as you're setting it up, sort of the context. So a lot of times, because a plan seems kind of complicated, it's a lot of documents to draw up. It's not actually one document, it's actually a bundle of documents. Companies will avoid setting it up, although there's no reason why you can't set it up earlier, until they get a Series seed financing, or perhaps a Series A. So in that case, you're setting up a plan while your investor is watching, and the plan is actually negotiated as part of the term sheet. And if you set up a plan earlier, oftentimes it can be enlarged during the financing anyway. So, no matter how far in advance you're thinking ahead, odds are your venture capital investors are watching as you're setting up your plan. So the size will be negotiated. Because the larger your plan is, the more you are diluted. So you would like the smallest plan possible, usually as a founder. On the other hand, the plan has to be big enough to do what it's intended for. So think, how long will the investor's money last? Let's say you're getting 3 million. Okay, how long will your 3 million last? What are your goals? What did you tell the investor you're going to do with that 3 million? Is it, building your first robot? Right? Is it getting a beta software out there? And how much hiring are you going to do with that 3 million to hit those goals during that time? And you can actually run through the scenario and think to yourself, all right, the 3 million, with the goals we have to hire 20 salespeople, each will get 40,000 shares, right? And you can do the math and figure out, oh, actually my plan is too big, that's proposed in the term sheet. Let's run the investor through this scenario and convince them that it can actually be smaller and I can be diluted less. So that's always a point of debate. The second question is, who are you going to give the plan to once you've set it up, once you've decided on the number? A lot of times the shares that you give away inside the plan can be an actual share, which usually is referred to as an RSA. It can be an option. So usually those are referred to as ISOs or NQOs. There's a lot of acronyms here. ISOs are usually the option that goes to an employee. NQOs usually go to advisors for tax reasons. And then an RSA you can give to most people, pretty much anyone. But again, it's a share. It's not an option to buy a share. So those are sort of the big three that you'll be granting out of your plan once you set it up. And it's worth mentioning that if you are issuing options, there's a two-step process. So not only will the employees have to accept the option, which is just sort of a formal sort of ritual of saying, yes, I understand, I can buy this option when I feel like it. They'll also, when the time is right, when they actually want to buy the shares and pay you money, they'll have to go through the process of actually exercising. So those two are divorced and happen at different times most of the time. And after that, your cap table will probably be very large after you set up your stock incentive plan, because you'll probably grant a lot of options under that plan to reward employees.
So we have incorporated, we have divvied up our initial pie among founders, we have defined a stock incentive plan, and probably for some period of time, we're going to be fairly heads down building our product for our company, getting out to market, trying to find some initial traction, whatever those major initial milestones are. And ultimately, in most cases where we're on the track of raising capital, we're going to start thinking about financing. So there's many different financing vehicles that we're going to talk about, and they have different implications, both in terms of how they function, what they do, typically what they look like, and some of the things that you need to be thinking about as a company as you're approaching those items. So the first of which we'll talk about are bridge notes or safes, both of which are two different vehicles that we typically see in companies a little bit earlier on. The reason for that is because it allows investors to put money in that will convert to equity later. These are essentially saying that this equity or this amount of money is going to be converted based on a later financing. So when we get to those Series Seed financings or a Series A, depending on how your company progresses, there's actually a term sheet which is saying this is the price per share. The bridge notes and safes would then convert as a debt alternative in those rounds at either the agreed upon price of the Series Seed or Series A, or that bridge note or safe might have some terms in it around discounts and caps, essentially giving those early investors some ways to have greater benefits of acknowledging the risk that they were taking by investing in the company earlier on. There are quite a bit of complexities in terms of both the math and the vehicles there. So I definitely recommend some follow-up reading for those who are starting to think about these early financing vehicles. Two great blog posts that we have, one titled "Show Me the Money, Early Stage Financing Options." And then there's a couple of others that you'll find in the blog if you sort for financing options. When we talk about Series Seed equity financings, we're typically talking about a slightly larger amount of money, maybe from a more institutional investor, a fully fledged VC fund or micro VC, as opposed to maybe an angel, friends or family, someone who's investing earlier on. As we talked about earlier, founders looking for ways to get their money into the company. These are some of the options that they have as well. So putting in a convertible debt or a bridge note or a safe for the money that you're putting into the company does make a lot more sense than using that as an equal exchange, so to speak, for your shares. That's going to be something that's a little bit cleaner, makes more sense in the long term. These are some of the things that you'll want to think about in terms of your Series Seed or your seed stage financing options. So our cap table will continue to get more complicated as we bring on investors. You'll see not only is this cap table a little bit larger, but it also has more columns. If we look down at the bottom, we'll see a debt holder, Reviga Capital, who has invested $200,000. That debt is a convertible note or a safe. So what they're saying there, as we talked about earlier, is this will ultimately convert if and when the company raises a round with a priced equity. So a price per share. And again, that might have a cap or a discount to help essentially reward Reviga for investing earlier on. In terms of thinking about your cap table, we've talked about a lot of actions that continue to develop it, make it more complex. As you continue to scale, it will grow and grow and grow. And historically, all of these activities in the cap table itself have been kept in very manual ways. So your legal counsel, your attorney might have kept it via paper. They might have had actual physical stock certificates for stocks that people owned. In a slightly more modern version of that, it might be an Excel file, but essentially you are paying your counsel an extra fee to say, hey, keep this document here to tell me who owns what, and to be able to share that when we get to investors. This has greatly adapted in the last couple of years. We've moved to a much more modern version of this, including Shoobx, where we're keeping this in a more digital manner. We're using software, we're using actual platforms to manage not just keeping of the table, but some of the complex math that we talked about before. So some of you all might have a cap table right now in an Excel file or something like that, but as your company continues to grow and you start taking on investment, that's going to become very, very difficult to keep up. And so the main advantage of using software or platforms is, one, to make sure that that information is correct and being appropriately handled, but also it gives you the ability to start automating some of the work there and ultimately giving you something that is easy and accurate to share with your investors or potential investors. So as we're talking about potential investors, and particularly when we're thinking about some of these more institutional rounds, we're going to go through a due diligence process. And so when we hear about due diligence, we might think about business due diligence, which is things like, does your product actually work? Do you have customers? What do their contracts look like? Are you an actual business? Are you being honest in the things that you're telling and pitching towards investors? And then as we continue through that process and we actually move towards the financing itself, we move into legal due diligence. So this comes back to the story itself, the story of your company, not just who owns it, but how it has gotten to where it is, what other kind of vehicles have been invested in the company before, what is the actual documentation behind those, both from an equity standpoint. Right, we talked about the different forms of stock options and the potential vesting around those. Do you have the documents for that? Do you have the proof that these people own the specific parts of the business or have the option to own those specific parts of the business? And again, this is where software can really come in handy to help you keep a neat and tidy record of all of these things. Unfortunately, one of the things that we have seen far too often is folks wait until they're getting investment that requires more serious due diligence to actually clean up this documentation. And when this is happening in a rush, when this is happening from a more disorganized place, we can see that cleanup run actually, in unfortunately some cases, hundreds of thousands of dollars in legal fees. So one of the things that we definitely hope to see and encourage folks to think about is getting organized and being very thoughtful about how you're keeping all of this documentation as soon as possible, because it's like keeping a clean house, right? If you keep your house nice and tidy, if you put things back where they go on a regular basis, when you do have guests coming over, it's a lot easier to clean things up and make it presentable. But when you let things get more dirty or more clean, the dirty dishes pile up, the laundry needs to be done, it takes serious time, effort, and in some cases money to get someone to help you to clean that up for you. And so thinking about that early on, as you all are going through incorporation, as you are going through these initial stages of your business, can really pay dividends in the long term, whether it's using a platform, whether it's using Shoobx, or just being really thoughtful and organized and keeping those documents up front. It really will benefit you in the long term. So just to kind of close things up before we go to questions, Shoobx does have an in-kind sponsorship with Clean Tech Open, so you can actually get your first year of Shoobx subscription free. To go into really what that means very briefly, we talked about Shoobx as an operating system. We talked about how you can keep your cap table in Shoobx, but Shoobx will also help you work with legal counsel to ultimately facilitate some of these specific activities that your business will do as you continue to grow and scale, ultimately in a way that helps you save money on your legal fees. And as you approach some of the more large ticket items like equity financings, we do have some particularly awesome and incredible things going on there that we'd be happy to talk to any of you about in more detail at a later date. but we want to make sure that we have plenty of time for questions. So we'll open it up now. And if you have any questions specifically, please feel free to unmute yourselves and jump in. No specific questions? Or if you're having trouble unmuting yourself, feel like sending into chat as well. So we do have one question via chat. Cap table is very sensitive data to show to public. How secure in terms of the platform and keeping such sensitive data? So that's a great question. When you're thinking about due diligence, how are you going about sharing this information? Not just your cap table, but the legal documents that are associated with both the cap table, your employees, etc. So Shoobx specifically does have a secure data room, and there are other platforms that you can use for just data room purposes, but we are secure in terms of being hosted on AWS, having ISO certifications, various other security mechanisms. And then when you're actually sharing this information with potential investors, you're giving them access to specific parts of your data room or the whole thing, depending on how you're going about it. And you're enabling diligence mode, so that way you can track their actions. You can make sure that there's watermarks on any of your documents if they're downloaded, but also thinking about it from more of a traditional kind of hard security standpoint, as well as tracking purposes. So hopefully that's good answer.
And just to mention, because we do HR as well, not only do we have the cap table numbers, we have people's social security numbers. So that's part of the reason we have ISO certifications, where we actually pay for outside security audits. So yeah, that's a great question. Lindsay, I noticed that you asked about what happens to the cap table when you start adding debt. So convertible debt is sometimes informally called bridge note. You might, have a SAFE or a KISS, which, is technically not debt because there's no maturity date, but let's be real. Bridge notes, convertible debt, KISSes, and SAFEs are all in the same category. If that happens, usually the cap table will say, this investor put in this amount of money. And then later, when it actually converts, you'll delete that and say, this investor has this many shares now. But you're correct. In the beginning, it's a little odd to put convertible debt on a cap table, although it's necessary, because you're basically just putting the money they put in, and you wait to see how it converts, or if it ever does convert. It may not.
And on the one specific slide of the cap table, Lindsay, where we did have a convertible note in the system, those debt alternatives are held in a separate part of the cap table that stays as the monetary value until it converts, as opposed to the common or preferred shares.
Mm-hmm. Yep. Any other questions? Anyone want to chat another question before we wrap up? That is a great question, Amir. And if you go to shoobx.com/pricing, it lays out the pricing, but it depends on how big you are. So depending on how large or small you are, it's cheaper or more expensive.
So our goal from a standpoint of working with startups is to make sure that we're helping you scale. So part of our key tenets is to help you with legal automation, to cut down on costs, to help you grow efficiently, and to help make sure that you are ultimately successful. And in that, we tier out our pricing, as Kathy was saying, with the size. So as you grow, you'll move through various buckets but our platform as a whole is available to everyone who's subscribing. You're not paying for different features. You're getting access to everything that you need to run your business on Shoobx. Any more questions from folks? We're happy to talk about Shoobx, our platform. We're also happy to talk about the due diligence process. Any questions about equity grants, investment vehicles, you name it, anything that we've covered today, whether it's Shoobx or more specific to things about scaling your business. Great. Well, if there's no more questions, we'll give you all a few minutes back in your day. We know how valuable time is as you're running your business, and we'll make sure that you all get some follow-up through us with our contact information, some additional resources, but we highly recommend to anyone who, one more quick question. While we're waiting for the question to be typed in, the last thing I wanted to say was just make sure that you check out the blog. There's tons of great content there as you're wrestling with all of the complex questions about funding vehicles, et cetera, to running your business. So I highly recommend that. In terms of subscribing, I assume that you mean setting up an account. If you're on the home page, there's a Get Started button, and you'll want to click on that. If you are not yet incorporated, the first option on that form will be to incorporate. Again, that says specifically a Delaware C Corp. And then if you are an existing Delaware C Corp, there's a second option there, which says I'm an existing Delaware C Corp looking to get on the platform. And then your final option is learn more. Again, if anybody does have any questions, we're here and happy to help walk through whether your company is compatible with the platform, any questions that you might have about the capabilities, or anything else.
All right. Thanks, guys. Have a good one.
Thank you, Kathy and Bryce, and thank you all for attending. Have a great afternoon.
Certainly. Enjoy the rest of your week, everyone.